You've probably seen headlines like, Company XYZ to go public. But what does that really mean? And more importantly, should you jump in? When a company goes public, it's basically offering a part of itself, called shares, to people like you and me. This happens through something called an IPO, or initial public offering. Until then, the company was privately owned by a few people or institutions. Now, it becomes public and anyone can own a piece. But why would a company want to do that? The most common reason is to raise money for expansion, hiring, marketing, or paying off debt. Sure, they could take a loan, but loans mean interest and repayment. With an IPO, they're giving up a small ownership stake in exchange for cash, with no obligation to pay it back. Going public also boosts a company's visibility and reputation. A listed company is seen as more trustworthy by banks, customers, and the market. And there's another reason: early investors and promoters often want to cash out some of their shares. That's called an exit. So yes, companies raise money, gain credibility, and allow early investors to book profits. But going public isn't free. Now they have to follow regulations, declare results, stay transparent, and answer to thousands of shareholders. Once listed, the company's shares are bought and sold daily in the stock market. The price keeps moving based on what investors think it's worth. And here's something most people don't realize: the IPO price is not set by the market. It's decided by the company and its bankers. That's why, when a well-known company goes public, there's often a lot of hype. Prices shoot up on listing day. But after a few days, reality sets in, and the stock price settles to what the market truly believes it's worth. That's why many companies time their IPOs during a bull market, when investors are excited and valuations are high. It's the perfect time for promoters and big investors to offload their shares to retail investors. And here's where you come in. As a retail investor in India, you can only apply up to rupees 15,000 in an IPO. Even if you get a 30% listing gain, that's just rupees 4,500. And that's if you get the shares. Most popular IPOs are oversubscribed by 50 to 100 times. It's like a lottery. Your money stays locked for 3 to 5 days, and chances of getting shares are very low. Meanwhile, you might miss other better opportunities. Can you really build wealth this way? Let's be honest, IPOs aren't bad. But they're not shortcuts to riches either. Understand why companies go public. Understand what's in it for them before deciding what's in it for you. If you like this video, smash that like button and subscribe before this offer closes. Don't worry, no money will be blocked, no oversubscription tension, and everyone gets full allotment. And if you want us to break down a real IPO case study, what went wrong, and what most people missed, just drop a comment below saying yes, case study, and we'll bring you the truth no one else is talking about.